Hello everyone, it's Ted Bauman here, editor of the Bauman Daily, as well as the Bauman Letter, and a back-end service, a specialized stock picking service called Profit Switch, which has been spectacularly successful actually over the last year or so. And I wanted to let you know that we're going to be having a special event to introduce you to some new developments in that service. If you look at the description of this video below me, you'll see that there's a link to sign up for a special what we call a summit that's going to be held on January 27th at 1 p.m. Eastern Standard Time. That will explain to you what we're doing, and we're basically making an offer for you to join the service at very, very discounted rates. So please do consider signing up for that. Before we go on to the meat of today's discussion, a couple of housekeeping things. One is no, my cricket bat is actually not something that Sunil Gavaskar himself actually owned. As you can see from this note here, there was an interesting discussion. Slapi Enoch asked, is it a cricket bat? Somebody came in and said, yes, it belonged to Sunil Gavaskar, who's one of the great Indian batsmen, a fantastic opening batsman, who indeed had an average of over 50 a test, but that is not a bat he used. It's a Sunil Gavaskar branded bat that I bought in Mumbai probably 20 years ago, almost at this point. Slapi Enoch, nia ek slapi, ek werk. That's what I do here. So anyway, that's the story behind the cricket bat. I wish I had an autographed bat from the great guy. You can hear him often commentating in the cricket. The other thing is I'm going to try to keep my videos shorter this year. I've noticed a lot of people actually only watch them about halfway through. And then I see in the comments that they have said things or raised questions or made observations that were actually dealt with in the second half of the video. So I realized, well, people don't have long attention spans these days. I understand that everybody's busy, so I'm going to try to get straight to the point. My point today is I want to give you three interesting picks that I think might actually be good winners for you this year. One of them is based on a previous valuation. It's a deeply undervalued stock that could bounce back strongly. The other two are new up-and-coming stocks. I think one of the up-and-comers is preferable to the other, and I'll explain why. So let's start with a chart that shows why I think American Airlines is a stock that you should consider buying. Now, as we know, the whole airline industry has been in a terrible state since the beginning of last year when COVID hit. And part of the strange outcome of this is that of the four majors, two of them have rebounded relatively well, but two haven't. The two that have rebounded are Southwestern Airlines, that's the orange line, LUV, and Delta, DAL. Now, Southwest has rebounded because it's a much stronger airline financially, and it's much better run than the others. Delta has rebounded simply because it's probably the biggest and most extensive and has the most cash flow, if you like, and that gives them an opportunity to be able to adapt quickly by changing around their routes and all that sort of stuff. But look at the other two. Look at United and AAL, American Airlines. They're both right down there. They haven't really recovered very much since their big loss at the beginning of last year. What I want to draw your attention to is where American was back at the beginning of 2018, which wasn't that long ago. It was the highest valued of all of those airlines. It was significantly higher than all of them. And in fact, that wasn't the first time that happened. Back in late 2014, it was also at a very high valuation. Now, my thesis is that the airline stocks will probably rebound. They have to at some point, otherwise they have to shut down when the vaccine starts to get out and about. And I think that one of the good plays that anybody could make at this point would be to put some money in American Airlines now in the hope that it is going to get back up to its previous highs. It may not get all the way there, but look how far up you have to go. Now, what are the underlying considerations you have to have with American? Well, American, like most airlines, carries a big debt load. It's a high volume, low margin business. In order to expand, they have to borrow money and then pay it back through operations. So there's been a lot of difficulty there. But that's the same with all of them, with the possible exception of Southwest, which has done reasonably well. They've actually managed to survive better than most through judicious cash management before COVID hit. With American, I think the critical thing is that they are seen essentially as a low-cost no frills airline. And I think that's where they're going to be heading in the future. They're really going to try to trim back. They're probably going to rationalize their fleet. They're going to try to focus on developing particularly their regional routes in North America, Central America, and into South America. And I believe that if they come under good leadership, which will happen if their shareholders put a lot of pressure on them, which they are already doing, they will bounce back. And again, they may not bounce back as high as they once were, but they'll bounce back a lot more than they are right now. So that's my first pick for you, a deep value play, American Airlines. Remember, you heard it here first. Maybe you didn't hear it here first. I'm sure I'm not the only one who suggested it, but I do think that it is a good bet right now because we are back on the upswing with the airline stocks eventually. The second is a couple of what are known as SPACs. Basically, that means special purpose acquisition vehicles. It is essentially a way of taking companies public. The basic idea is that a bunch of people get some money together, a bunch of investors with deep pockets. They put together a company that is an acquisition vehicle that goes shopping around to buy a currently private company and that is in an exciting field. Now, this has been a really busy season. Actually, the last year has been really busy for SPACs trying to pick up stocks in the EV space, electric vehicles. A number of companies like Nikola went that route, Highline went that route. So there have been a lot of SPACs going on. There's been some in the cannabis sector as well. But I was looking at SPACs actually operating in the electrical vehicle charging sector, and that's what I want to present. Now, the basic thesis for the charging sector as opposed to EVs is that whereas individual EV companies may fail or may succeed, chargers are going to be everywhere. They're going to be needed regardless. So whereas you have branding issues, you have consumer reliance issues, you have all kinds of issues related to the manufacture of electric vehicles, with charging, you basically need them. They're going to become a commodity. And the big question is, whose commodities are they going to be, and what kind of commodities are they going to be? So here are two SPACs that focus on the charging sector. And again, remember, the key thing is, it doesn't matter who wins the electric vehicle race itself, you're still going to need lots of chargers. So getting in on the ground floor with these companies is a good thing to do. The first one is a company called Switchback Acquisition, or SBE. They announced late last year that they were in negotiations to finalize a merger with ChargePoint. Now, ChargePoint is one of the biggest standalone normal charging companies in the United States and around the world. And basically, it provides these charging ports that you sometimes see I see them at my local Kroger. I see them, various other places around where I live here in Atlanta. But basically, they are in that field. So when this acquisition is complete, we expect that it will relist under the name, something to do with ChargePoint. But now that everybody knows that that's what's going to be happening, let's look at what the share price has done. Since the first news came out about this in mid-September, the stock has appreciated by about 300%. It's down a little bit from its highs. But what I like is that it has had a consistently rising moving average, both the 50 and the 21-day exponential. And it has bounced off that 21-day a couple of times. As you can see, it's tested that red line, the blue line being the stock. The blue line has tested the red line a couple of times, which tells me that there is investor support at some level. Now, with stocks like these, what you're looking at is a breakout to a higher level. This is a very early days for this stock, but I think given this company's footprint, I'm talking ChargePoint, of course, I think once they are actually listed as ChargePoint and the whole deal goes through, we could see sufficient appreciation in this stock price. Now, you'll note if you look down at the moving average convergence data on the bottom pane, that right now, there is weakness. There's buying weakness for the stock. But that's a good thing. That means that you have the opportunity to get in at a lower price point than you might otherwise. So this is an opportunity, I think, to grab a stock that has the potential to significantly gain again at a moment of a temporary short-term weakness. And remember, all EVs, all renewables, everything are really going through a big sort of bull phase, or about to enter a bull phase, thanks to the consolidated Democratic control of Washington and all the goodies that they promise for the renewable sector. Now, ChargePoint, once it's complete, its merger with SPE, will effectively be an operator in what's known as the 1VG charging segment. Companies like ChargePoint and Blink, which is another one that's been very popular, essentially provide a commodity service, which is charging stations. You plug in your vehicle, the charging station gets its power from the power grid, you pay for the electricity on the spot, it charges your vehicle while you're shopping, you come back out, you got some juice and you're ready to go. But there's a different approach to charging that's called V2G. And V2G is where you have a two-way relationship between your vehicle and the grid. You can charge it, but you can also feed energy back into the grid during periods of high demand. So for example, let's say you have a fleet of electric utility vehicles or electric delivery vehicles or school buses or something like that. Or you are a private car owner with an electric vehicle plugged into a port at your home. Well, overnight, when there are big demand for electricity, let's say during the summer, a V2G charging system would allow those vehicles to feed excess electricity back into the grid and get paid for it. And that would allow them essentially to lower their overall cost of operation and their cost of electricity by getting paid a slight premium for giving electricity back and for more than they actually paid for it when they first charged. Now, this is something that is already in use in a lot of parts of the world in residential charging. It's used extensively in Europe in particular. And so this is something that a lot of people are talking about as the next big thing in vehicle charging. Now, there's a company called Newborn Acquisition. They are proposing to merge with a charging company called Nuvi, which is a leader, not just in the United States, but globally in the V2G charging technology. As I mentioned, it's very popular in Europe, and so they have a lot of installations in Europe. Now, one of the questions is, what is this company likely to do in the United States? Because that has heretofore not been its primary market. We know that Tesla, for example, has been building an EV charging network for a long time, and Elon says that the company looked at V2G but decided not to do it because consumer interest was not particularly high. I think that's short-sighted. I think that part of the role for any innovator, as Elon Musk knows very well, is to create demand for something by showing how useful and exciting it can be. And V2G, I believe, is eventually going to become a very important part of the electric system at scale. Remember, right now we just have the very, very beginnings of electric vehicles and charging. What we need to have at its scale is a system that works, that makes financial sense. And I believe that V2G, by giving you this opportunity to play both sides of the electrical grid equation, buying electricity, but also selling it back to the grid, at a premium, is going to be very attractive, especially to fleet owners of electric vehicles. And that's the big thing right now. You got companies, like I said, like Highline, for example, which maybe isn't a good example because it's primarily hydrogen, but there are others, Lordstown Motors, for example, that are betting on electric vehicles, pure electric. Also, Tesla with their Semi. The Tesla Semi would be using this electric charging. So bottom line here is that there's a tremendous growth opportunity in the United States for this company. So let's look at its chart. It announced, or rather Newborn Acquisition under the ticker Mbaku, NBACU, announced back in November that they were going to do this. Since then, the stock has continued a typical sort of choppy up and down move. Big move just after the announcement, then profit taking, then a little bit of up, then down, then up. Right now, the trend, I think, is pretty much upward. You can see the 21-day and the 50-day are both moving solidly upward. But again, like the previous one, like SBE, we see that it's consistently bouncing off that 21-day exponential. And I think it's going to keep doing that. Again, like SBE, NBACU is also showing a little bit of buying weakness early in the year. But I think that's, again, going to turn around very rapidly once we see big movement towards renewables and support for renewables from government. So there you have it, 3 picks from me this week, and I hope you enjoy them. And also, I hope you enjoy, if you do sign up for our seminar on 27th January at 1 p.m. Eastern Time, it's in the link below. I really have an exciting opportunity for you, and we're making some promises about how we're going to perform this year with your investments in our Profit Switch portfolio. So please consider doing that. Until then, I'll talk to you next week. Bye.